In this video, I'll be going over how you can buy a business as a highly motivated and resourceful individual or as a business owner. Now, this is going to be a completely free course type video, which I'll be doing. I'll be using my notes that I normally use when I am coaching clients on how they can grow their business via acquisition or how they can deploy their capital when they are looking to acquire a business after they've had either some inheritance or they've had an exit for themselves. Now, before we get started, it's very important to understand that anyone can do this. So even if you're a complete beginner, you can actually buy a business. And if you're a business owner currently doing, millions in revenue and hundreds of thousands or millions in profit, it's equally possible for you. Of course, the person who is a business owner and they're doing millions in revenue, and of course they have a lot in profit too, they will be able to do this a little bit easier than someone who is just getting started. But in any case, this is going to be an exact step-by-step process on how you can go and buy a business. Now, the first thing that you need to do is you need to identify a target profile, what I call a target acquisition profile, TAP. And what that means is that you need to get started from what type of business are you going to buy? What is the criteria that you're going to use when you're looking to buy a business? Now, it's very important that you get this criteria to the T. It needs to be very, very specific because there's going to be so much out there on the market, and of course from people that you know, competitors or people in the industry who may be looking to sell. Are they right? Is that business right for your acquisition? Right? That's something that you need to ask yourself. Now, if you're a business owner at the moment and you've never done a business acquisition before, the best thing to do is to buy another business which is exactly like yours now. So you can just go through the process, learn how it is to buy a business, and then you can start going into maybe different areas within your industry, your sector. But always start off by buying a business which is exactly like yours. And that's always going to be easier because you understand the dynamics of the business, the operations, the sales and marketing, the employee structure. You understand a lot about the business already. So the target profile is really, really important. You need to have a minimum criteria. Now, I always advise clients, and when I'm looking at businesses, these businesses normally what I'm looking at and what I advise clients should be doing at least 2 million in revenue. That's the bottom line. If you do anything less than 2 million, okay, maybe 1.5. But even 1 million in revenue is a little bit less. And I'll tell you the reason why is because a business which is doing 1 million in revenue, you can get financing to do that type of business, but it's still normally too small. People who are looking to finance business acquisitions, whether that's institutions, whether that's lenders, whether that's investors, they start getting interested in acquisitions when they're normally 2 million plus in revenue and 250,000 in profitability plus. And that's really important for you too, because when you are buying a business, you don't have access to 100% of the cash flow on day one unless you have an investor who's looking to invest, or if you're a business owner right now with retained earnings within your business and you want to deploy that capital without having a immediate return. Now, of course, you always want to identify what's your cash on cash return. That's without a doubt. But if you're not looking to reap that immediately, then that's something which you can do. And if you're looking to reap it immediately, then 250,000 is the bottom line. You don't want to go below 250,000 in profit, I'm talking about. And the reason why is because after you've paid for the acquisition cost, you'll probably be left with about 100 to 120,000 a year. And that's about £10,000 a month or $10,000 a month. And that's what you want to try and bring to your business when you are looking to do an acquisition. So having that target profile is really, really important. And it's important to understand that you want to go for good businesses within your industry. So if you've got let's say for example, your business currently generates £2 million or $2 million in revenue with 10 employees. If you have another business which is doing 2 million, but they've got 20 employees, that's not a good business that you want to go and buy. On the other hand, if you've got another business which is doing 2 million in revenue and they've got 5 employees, so half the number of employees that you have, that is a good business to buy because they're achieving the same revenue as you, but they're doing it with a smaller staff count. So that's something that you need to look at. So what's your minimum revenue? What's your minimum profitability? What's the team size? Those kind of things are really, really important. If you're looking to deploy capital after an exit or after inheritance, you really need to choose an industry in which the best things to do is to do high turnover and profitability with a smaller staff count. Yeah, because human capital is really, really difficult to manage. Yes, you want to try and minimize the amount of human capital that you have to deploy to earn that revenue and to earn that profitability. So if you can do a business which has got good turnover, good profitability with smaller staff numbers, as opposed to a different business or industry that you're looking at, you want to choose the one with the lower staff members. So that's your target acquisition profile, and of course, there's so much more that goes into it that we go through with our particular clients to make sure that, right, your business is this, we need to look at that, right? So we build that together to make sure that you are buying that business, which is good for you. Now let's go ahead and take a look at some other things. So deal team is really important. So a deal team is advisors. So if you're a professional within your industry at the moment, of course, then you are the industry expert and you can analyze a business and the operations. Maybe if you're good at finance, then you can look at the finance from a high level. When I say high level, I mean like from a basic level. You always want to get a CFO or an accountant who understands business acquisitions. Your accountant normally doesn't understand business acquisitions. So accountants have different specialisms. Some are just there for tax minimization, which is normally how business owners are employing their accountants. Some are they're good at looking at bookkeeping and so on. You really need to have an accountant who does understand business acquisitions, because they'll be able to interpret the numbers from what you need. Now, this is really important because your business that you're looking to acquire, you need to look at that business and say, right, if that business is currently doing, for example, 250,000 in profit, is the owner involved in that business? At that level of business, the owner is probably involved, quite heavily involved. However, if you're looking at a business and that business is doing, for example, 2 million in profit, then normally the owner has very minimal involvement within the business. When I say there may be the CEO orchestrating the, pulling the strings to make sure the business is running and coaching the team and so on, but that's, they're not doing any day-to-day management in that way. So what you need to identify, okay, if the owner is there, let's pull the owner out of the business, because most owners do not prepare for an exit. All of the owners that I work for who want to exit, my main thing is about exiting businesses. All the owners that I work with, we work to exit them out of the business before they go to sell. But majority of the businesses that you're going to look at are not like that. So what you need to do, you need to pull, the owner out of the business. And what you need to look at, okay, how much will it cost for me to replace the owner? And then you need to adjust the profitability according to that figure. And then once you've got the profitability which is adjusted, then you've got your new EBITDA or your new profitability figure. Once you've got your new profitability figure, then you can work out what's the DSCR, which is the debt service coverage ratio that I need to be able to buy this business. And then what am I left with afterwards? Because you've got all of these acquisition costs. Remember, you're hiring a lawyer, and also your lawyer needs to be someone who understands how to do business acquisitions. You can't have a conveyancing lawyer who understands property deals and they're looking to advise you or do your deal paperwork on how to buy a business. It just doesn't work that way, right? So you need a lawyer who understands how to do deals too. So your accountant and your lawyer is going to be really critical to ensure that they know how to do deals. Now, with that deal team, now we're coming back to the finances. So you've got all these deal costs that you need to pay for. Now, normally you can, you pay for that within the first 2 months, 1 month, 2 months, 3 months, depending on the size of the acquisition that you're doing. But you need to, okay, what am I left with actually? After I've got my debt service covered, after I've got to replace this manager, and there's always things that come up. With an acquisition, there's never been an acquisition that I've worked on myself or an acquisition that I advise my clients on in which that acquisition produces the exact profitability as forecasted. There's going to be something or the other that pops up. Very rarely is it on the positive side. It has been once, it's been on the positive side, but normally it's on the negative side. but you try to forecast that as much as possible. So you really need to look at, okay, what is it that this business is going to produce for me, for my business after I've taken it over? And there's so much. There's another thing. I need to backtrack a little bit. What I need to backtrack on is that if you're a business owner at the moment and your business is doing, you're buying within your industry, then what you need to identify is that, am I going to integrate, meaning merge this business into mine, or am I going to operate as a standalone? Because if I'm going to operate as a standalone, there's different parameters. And also you need to understand, what's your total goal? Why am I holding this iPad here? Right. What's your total goal when you're buying? Do you just want to buy one business? Do you want to do a roll-up? Do you want to buy 5? What do you want to get to? What's your ultimate goal? Do you want to buy 10 businesses, roll them up and sell them all together, and you want to have that as your grand scheme exit? Then that is a different type of acquisition that you're going to be doing, and a different way that you're going to be integrating. It's really important. There are many people, obviously, who teach this on how to buy a business and everything. But, me, I'm in the trenches and I'm doing this on a daily basis. And there's one really important thing that people miss out, is what happens after you close the business. Close on the business, meaning you've completed the deal. You really need to understand what you're going to be doing long term, to understand what type of integration work needs to happen afterwards. Because if you're going to operate as a standalone, there's less integration that needs to be had. However, if you're doing a roll-up, then there's more integration that needs to be had. If you're doing a merger, then you need to integrate your business completely. Sometimes you might just want to buy the customer list, or you might want to buy the assets of a business. So understanding what your ultimate goal is going to help you building that target acquisition profile, the TAP, and also how you're going to be looking at these businesses and what you're going to be left with after you've purchased this business, after you've done your debt service coverage ratio. Even if you're deploying your own capital, your retained earnings or your capital that you've received after an exit on inheritance, then you need to understand, how long is it going to take me to get my capital back? I like to work on the rule of thumb of a maximum of 5 years. I want to get all of my capital back. Now, if you, for example, got more of a long-term mindset that you want to build a holding company, for example, then you can do an X purchase. That's not a problem, because you're looking for really high-quality businesses. And if you're going to do that kind of business, you need to make sure it's a certain size and everything. So there's a lot that needs to go into it. Anyway, so once you've looked at you've got your deal team there and you've looked at the finance, you really need to understand the financials of the business that you're looking to buy. Because, and this is where you can really, if you're a business seller who's watching this video, this is the part where you need to really understand that you need to have your documents prepared, because the people watching this video who are going to be buying businesses, they're going to pick holes in your paperwork. So as a business buyer, you need to take a look at their financials and you need to ensure that you're able to pick out the gaps, because there's going to be gaps. Unless you're buying a business. Now, normally, if the business that you're buying is doing 3 million in profit or more, then they'll have good financials. Normally, they'll have good financials because they've got a whole professional team which is doing the accounts for them. And the accountant is sophisticated. So then you've got a good basis there. But anything sort of 2 million, 1 million or less in profitability, you can see that they haven't got their finances in order. So that's why you really need to be able to understand the financials. Now, once you've understood the financials, you need to go out and raise capital if you haven't got 100% of the capital. Now, most deals within the small to medium enterprise space is that there's going to be an element of seller finance in there. Whether that's deferred considerations through a promissory notes, or whether that's earnouts, that's a different conversation. That's about how you're going to be structuring the deal. But normally you're going to deploy some capital. Now, I'm not talking about £1 Charlie deals. I'm not talking about, oh, I can only put £1 down on the deal. Now, don't get me wrong. I've done deals like that, right? Me personally, I've done no money down deals. But am I saying that's the normal thing to do? Am I saying that that's the thing that you want to do? Because only, a distressed seller will do that kind of deal. By the way, I never advocate for buying a distressed business. Unless you are a very, very good operator and pinpoint accuracy, targeted, that is the reason that business is failing. And I just need to fix that one thing, or those 2 things, or those 5 things, and I know this business is going to turn around immediately, and I know that people have done that. They've turned around businesses within 6 months, and then the profitability, and they go and sell that business, and that's fantastic. But I would say always buy a profitable business which is healthy. You have a distressed situation within the ownership structure as opposed to having a distressed business. So you need to go out and raise capital. Now, if you're going to raise capital, then you need to understand, are you going to raise capital via investors? Are you going to raise debt? Are you going to use retained earnings from your business? Are you going to pay cash for the business? Never pay 100% of the consideration on day one, by the way. Never, ever, ever do that. Even if you're going to hold back 10% or 20%, at least 10, 20%. That's the minimum that you want to hold back. Ideally more. I like to work on the basis of at least 30%, because what I'm saying to the seller, and I'm saying to them, look, if I'm going to buy your business, you need to show to me that you've got confidence in your business that it can perform. And for that, you're going to hold back 30%. Therefore, through the profitability and the cash flows of the business, you will get your money. And that's fantastic. I mean, 70% on day one is great, if you're going to be giving that to the owner. That's the minimum, by the way. Obviously, the lower amount that you can give on day one, the better it is for you as a business buyer. And of course, if you're a seller, the higher amount that you get on day one, the better it is for you. So once you've allocated capital, now you need to base your deal structure based on the capital that you can raise as well. So what I see a lot of people doing is that they make offers without understanding what kind of capital they can allocate to that deal. What you need to do first is that you need to get the financials, and then you need to go out to the market, and you need to get from investors or from your own business, from your own money, from lenders. You need to understand what can be raised on this business. After you understand what can be raised on the business, that's when you can start structuring an offer. So always go and raise the capital first, or at least get indicative offers. And once you've got those indicative offers on the capital raise on that particular business, then you're going to structure the offer based on that. Now, that's the clever way of doing it, because you understand, right, this is how much I'm going to get on this business from an investor, from a lender. And then I can go and structure the deal in that way, not the other way around. Right, so you finance the deal. Now, once you finance the deal, you need to go into due diligence. Now, due diligence is when you're investigating everything around the business. You want to do operational due diligence, financial due diligence, and you also want to do legal due diligence. I should say the other way around. Legal due diligence is first, is everything above board. Financial due diligence and operational due diligence. So you want to do all of that. Now, if you're a business owner at the moment and you're buying within your industry, of course you can do the operational due diligence yourself, or you can use some of your team members to go and do the operational due diligence. The financial due diligence, you can get that done through an accountant, CPA, or and the legal due diligence is done by the lawyers. So that team, your whole team, that's why buying a business is a team effort. And that's why you need to make sure you have these professionals around you who know how to do deals. So once you've done your due diligence, and due diligence can take, before that actually, you need to do LOI. So when you're making an offer, you write an LOI or a heads of terms. Now, my clients, they get copies on that, but so it's not a problem. But if you're getting that, someone can make a copy for you. Your lawyer can make a copy for you. And in the LOI, it's basically the offer that's been made and that's been accepted by the seller. Whatever's been accepted by the seller, it goes into the LOI document. It goes into the heads of terms document. Heads of terms in the UK, LOI is pretty much everywhere else. Letter of intent, heads of terms, HOTS. And you put the basis of the deal in there. Now, there's only two legally binding clauses in there. One, you've probably already signed an NDA, so the non-disclosure agreement's already signed, but normally it's baked into the LOIs and the NDAs. We have exclusivity. So you want to try and get a good exclusivity period when you're buying. So I always advise buyers try to get a longer exclusivity. I always advise sellers try to shorten the exclusivity. Obviously, that's going to be a negotiation. 90 days is ideal in the middle. So if you can get 90 days, both sides, I think that's a good balance on getting exclusivity, because you've got enough time to conduct due diligence around that business. So you really go deep. Now you go into due diligence, you're going into the legal structure, you're going into the contracts, you're going into the staff contracts, you're going into the customer contracts, you're going into the supplier contracts, all of these different aspects within due diligence. With financials, you're looking at their full accounts from the previous years, you're looking at their management accounts, you're looking at the balance sheet, you're looking at the cash position, you're looking at the cash flow statements. Any good business will have these, and if they don't, then you need to really identify, okay, why don't they have a cash flow statement? A business that's why these small micro businesses, they don't have these cash flow statements. If a good sized business has a cash flow statement, because they need to identify how much cash have they got on hand to conduct business, and that really helps you. So you look into all of that. And operations, you go and look at the management team. You're going looking at the administration team, the sales team, the marketing team, all of these areas, the positioning within the marketplace, the geographical coverage of that business. All of these need to be looked at when you are doing due diligence. And every business and sector is a little bit different, but there are a few things that you need to look at, which I've already listed out, of course, within this video. So once you've done your due diligence, you go and close the deal. And once you've closed the deal, of course, the business is now yours. Now, there's an important fact that you need to understand before we're talking about closing the deal, because what's going to happen with the business seller? The business seller either is going to do one of two things. They're either going to exit immediately, and when I say immediately, there's a handover period that needs to happen, and that's done normally about between 6 to 8 weeks is the normal handover period. Three things. That's the handover, number one. Number two, they're going to stay on for a short period of time to train managers or train you around the business. So that could be up to 6 months. And that's normally, I advise, that's a maximum time that you should keep an owner in the business. And if you're a seller, I always tell them that, look, don't stay in the business for longer than 6 months. You just want to be in there for the amount of time to make sure that everything's been handed over properly, training's been done, and the team is happy, and the buyer is happy, of course, and then you can move on. Same on your side. The third option is that you keep the seller in the business for 2 years. The longest I've seen is 5 years. So a seller stays on for 5 years and they become an employee of the business. So when I say employee of the business, they become your employee, right? An employee of the business. So they stay on for 5 years, 2 years, 1 year, 3 years, whatever it may be. I don't like that situation, purely because when a business owner sells their business, they still think it's their business when it's not, right? It's your business. Now you can do whatever you want with it. And the seller, they have ideas and they have thoughts and they have these things that they want to do, and they can't do it, right? Because you said no. And then there creates this tension. And sometimes it's, easily passes by, that's not a problem. But sometimes the tension can get quite strong. So it's really important that, I always say, right, I want you exited out of the business within 6 months. And I always advise buyers to do that. I always advise sellers, look, just go. So that's what you need to do with the sellers. You need to get that organized before any closing. You need to get that watertight. And again, sellers should have a plan. Most sellers don't have a plan, by the way, right? Most sellers don't have a plan on how they sell their business, prepare their business for sale, what they're going to do afterwards. They think that this business can be sellable. The hard truth is that most businesses aren't sellable because no one does anything to prepare them. And that's why you need to be selective when you're looking to buy a business. When you're looking to buy a business, be selective because there's more business for sale than there are people who can buy them. Especially if you're looking at below 5 million in revenue, below 10 million in revenue, then there are more buyers than sellers. There are more sellers than buyers. If you go up past 10 million, then there are more buyers than sellers. I'm pretty sure I turned that off. No, I didn't. Okay. Right. So you need to take a look at, okay, what kind of business you're going to be buying in that way. Now, you close the deal. Once you've closed the deal, depending on what your long-term plans were, now you need to integrate it in the way that needs to be integrated, right? So whether that's a full integration because you're doing a merger, whether you're doing a partial integration because you're doing a roll-up, or whether you're doing a standalone acquisition, it means you're going to buy the business, you're going to keep it as it is. It depends on your goals, what you want to do. And each of them requires a different amount of integration. So you learn how to, we teach how to integrate businesses, of course, but you need to understand how to integrate the business. Once you've done that, it's really important that you have real open communication with the team. This is a lesson that I learned myself personally, is that we bought a business and the closing took a really long time. The other lawyer was just crap. It was really, really bad. So it took a really long time. We were there, and it was outside of the area that I live in. So I was staying in a hotel, stayed there for a couple of nights, few nights, and the weekend came. We finally closed the deal. It was Friday, like 8:30 at night, 9 p.m. at night. We finally got the deal done, and then I left, and I didn't send any of my team members there for until 4 or 5 days later. Right, so the business was closed over the weekend, and then 4 or 5 days later, the following week, we sent someone. The staff didn't know what to do. They didn't know what to expect. Yes, I had communication in the sense that we were having video calls, but that's not enough. If you want to have someone there who's actually talking to the staff members, now you don't have to talk to the whole team. Let's say, for example, you've got a business which is, you've purchased, you've got 150 employees. You're going to talk to 100. You're not going to talk to 150 employees. You're going to talk to the management team, and the management team is going to deploy that information to their teams. So you need to make sure that you have some conversation. But if you've got a business that you've acquired which has less than, I reckon, 70 employees, 50 employees, something like that, you can bring the whole team together and say, right, I'm calling a big meeting. We've just bought your business. Hi, I'm the new business owner, and this is what we're planning to do. Right? And that's fantastic. Now, of course, if you're looking to deploy capital and buy a medium-sized business, then you can just deploy the capital. A medium-sized business, which is a business which is doing more than 10 million in revenue, normally has a COO or someone who's there as a paid employee. You just promote that COO into a CEO of that business, and they continue to run the business as they would, because they've probably been doing it for the last 5 years, 10 years, whatever it may be. And that's the best situation. But have that communication with the staff members after you've bought that business. So what's next? You got to grow the business, right? So you have to have a 100-day plan. So I like to have a 3-month, 90-day plan. You go to the management team and say, right, fantastic, we've bought this business. We're going to be doing some handover work to make sure that, okay, the integration is done. Take control of the bank accounts. Super important on day one. Now, banks are notoriously slow in processing, but you need to push them, yeah? Because ultimately, you need to get control of the bank account. Get control of the money first. Get control of the card processes, the bank accounts, all of the other different types, the credit control accounts, all of that you need to have 100% control on day one or as soon as possible. So once you've done that, so you say, fantastic, I'm going to do all of this integration work, get control on everything, and this is the 90-day plan. And the 90-day plan can be literally, we're not going to change anything, you carry on doing what you're doing. Or the 90-day plan can be, right, we are going to, put our foot down. I mean, when I say put the foot down, I mean put my foot on the gas with regards to marketing on this particular campaign that you've been working on. We believe in it, and we think that we should invest some more money into that. That's going to give them a focus other than the acquisition itself. It's going to give them a target on work, on operations. So they're going to then work on that and grow your business for you. If you go in without a 90-day plan and have no sense of direction, everyone's going to be thinking about you as a business owner, as a business acquirer. And you want to take their mind off that, and you want to push it towards some sort of goal that you've got them on, that they're working on, so they can focus on operations. And it gives them confidence that you know what you're talking about. Now, if you're looking to deploy capital, let's say you're not a business owner at the moment, you're looking to deploy capital, your own capital, excuse me, then the best thing to do is to hire a COO and get them to, give them a plan, tell them, right, we're going to buy businesses and this is what we're going to be doing. They should go and implement the 90-day plan for you. Because if you're going to be deploying capital, you're not going to be working there. Look, no one buys the business to run the business. If you're watching this video and you want to go and own or operate, then fantastic. But most of the clients that I work with, they want to deploy capital. They want to buy another business to integrate into their business. And then they've got a team already, that's fine. But if you're looking to buy a small business and own or operate, then it's a different situation, because you're going to go in and you're going to say, right, I'm the new owner. Everything that you thought before, just forget about it. That's what normally happens, by the way, if you think anything different. There was one business owner that I was, business buyer, I should say, that I was advising. They went in and they changed everything about the business. The whole culture changed. They lost half of their staff, and the current staff that they had, only 2 members stayed from the senior team and 2 members from the junior team, and they had to recruit a bunch of juniors because they couldn't get seniors, all because they went in and they changed everything about the business, and it was my way or the highway. And that's fine. I mean, it's your business now. You can do what you want. But you bought the business for a reason. Yeah, it's got existing revenues and existing turnover, existing profitability. You want to capitalize on that. So go slow in the beginning if you're an owner operator. If you're just deploying capital, you go there, you look at the existing projects, and you make them run with those projects. I think that's enough for this video. And if you want to find out more on how you can buy a business, I do in-person coaching. I don't have no course. Yes, there's some courses, some videos that I have made because there's, questions was always asked about these particular topics. But if you want in-person coaching, number one, how to formulate your TAP, your target acquisition profile, how to look at your business or how you want to deploy your capital, what industries you want to go in, what type of business purchasing strategy you want to use, whether that's roll-up, whether it's integration, or whether it's standalone, what's right for you. Then those kinds of things I work with business owners. But this is not for everyone. So if you're a £1 Charlie and you want to buy a business and you've got no money to buy a business, this is not for you, right? If you're highly resourceful, then it's for you. Yes. So don't apply if you are not serious. I don't want to work with anyone. I don't have time to work with anyone who is who can't actually do the plan and close on a business. I only work with people who are extremely motivated, or they're current business owners, or they've got capital to deploy. Then this works. So best of luck with your business acquisition plan. Again, if you want to, I hope this video helps you, and there'll be many more things on the channel. Even if you're a business buyer, watch the videos that I've got regarding business sellers, because that's going to give you a 360 view on the M&A process. The 360 view of the M&A process is so important. Once you understand as a buyer and the mindset of a seller, both, that's when you can do the best type of acquisitions, because you understand everything about buying a business from all sides. So that's that, and I'll see you in the next video.